Hello, everyone. Today is October 16th, 2022. I'm here today with Jordan Naidu. Jordan is an investment risk manager. Thanks for coming on the podcast, Jordan.
Yeah, thanks for having me, man.
So, just before this, we're speaking about the difference between investment risk managing assets versus something like analyzing stocks.
Sure. You want to start right off with the boring stuff?
Yes, just that real quick.
Just that. Okay. Okay. So it's just a high level on asset management, right? So asset management has nothing to do with banks, right? We call banks the sell side. They do a lot of different businesses. They sell stock, they value and sell stocks. They'll do mergers and acquisitions, IPOs, that sort of stuff, mortgages, and obviously bank accounts, right? Asset managers are what we call the buy side. So we create what we call funds. So you can have equity funds, which are of stocks. You can create fixed income funds, which are of bonds, and then you can have multi-asset, which is a mix of those. Then you've got things like real estate, private capital, and all the sort of more out there alternative sort of stuff. I cover equities primarily. So in terms of your question about, I guess, what the investment guys in asset management do is that they'll collect a portfolio of stocks. Typically, you'll have different options of funds. So you could have like global or by region or by sector. So like a global fund or an Asia fund, or maybe like a real estate stocks fund or an energy fund. So that's by sector. And the team is generally split up into two. So you'll have your analysts. So analysts will be divided into sectors typically. So in a global fund, you'll have maybe a healthcare guy, cars, clothing, etc., food, whatever, right? It's easier if one guy looks at, I say guy, obviously. I'm not talking about gender here, but just generalizing. One person will
Yes.
be looking at that sector, and they'll be able to compare different stocks in that sector. It just makes sense to do it that way. So someone covering cars, they'll go and see, Toyota, how they're doing, and then they'll compare them to Volkswagen or, whatever. And then they'll basically do various types of valuation analysis. You can do fundamental, you can do more factor or quantamental sort of analysis. And effectively, the output of their analysis will be what is the stock price that they believe it is, and they'll call this the intrinsic value of that stock. They'll then compare that to the stock price in the market today, and obviously, if this is higher, then they might suggest it to the team leader or the fund manager to invest that stock into their fund. What we're specifically speaking about right now is active fund management. So I work for a company called Schroders, and they only do active management. Obviously, something that's become more common in today's world is the passive fund management. We can talk to that a little bit, but that won't be so much. You won't have analysts in that team. They'll just be looking to replicate an index and benchmark like the S&P 500. The fund manager will be looking not just at single stocks individually. They'll be looking to create a fund of 40, 100, whatever many stocks in that fund, based on how active and volatile they want it to be versus diversified. So they'll need to take into account the risk and performance of each stock together rather than individually. So if you take a bunch of stocks that are in the energy sector, but you're selling a global fund, yeah, the energy sector might be killing everyone else this year, but you are then at risk of a very specific sector and style of investing. So if you're a global diversified manager, you need to be accounting of these factors rather than just taking on the ones that just have the biggest gap between the intrinsic and the fundamental value of the stock. But yeah, and they'll package or put together their the stocks that they want, taking account of these risk factors, and then they'll sell that as a product to retail people like you and me, or to institutional clients, pensions, insurance companies, whomever. So yeah, does that make sense?
Yes, it made sense. Actually, it made a lot of sense. And how has it been?
How's it
How long
been?
how long have you been a investment risk manager?
So I've been doing investment risk, funnily enough, since February 2020. So I had a month on my desk before everything went everything went crazy. It's
Wow.
quite interesting. I was working in a different department before that, and I was in that team for about 2 years, and I had such limited exposure to the actual product of our business. you know I was so far away, so it was quite nice to be a lot closer. I've always had very little interest in getting into fund management myself. It's a very stressful job, obviously, and you are directly responsible almost for tens of millions, hundreds of millions, if not billions of pounds of people's money, right? Even if it's an institution like a pension company or an insurance company, that matters to the everyday people. So yeah, so it's nice to be so close to our business units, our investment desks, meeting these people, obviously very intelligent people, and getting insights into how they do these things. It's obviously a skill everyone should have, knowing how to invest in stocks and things without blowing up your savings. In terms of the job itself, it's obviously like during easier times in the market, because we're active managers, we compare ourselves to the benchmark, right? So rather than investing in it, we try to beat it. That's how we make our fees. So yeah, so it's just I lost my train of thought there, but it's just during easier times, it's just about outperforming the benchmark. Risks aren't so prevalent there, not systematic risks at least. But then obviously during more downturn periods like now, it's sort of all hands on deck, right? You really need to be quick to the mark. If you see potential areas of risks, there's very little time between when you receive that information or discover it and when the market will realize, and sort of it will play out a little bit. So it's it can be a bit tense, it can be a bit fast, but it's like I said, it's an interesting job. And I've enjoyed it so far.
Wow. So right now, as times are more tumultuous, there's you have to be faster with that risk assessment.
Yeah, I mean, like, so for an example we did is that we were looking at the following the mini budget in the UK, right? Mini budget when we had our new Prime Minister and Chancellor, they announced quite a big package of tax cuts, right? That
What's a
immediately.
What do you mean by mini budget?
So in the UK, annually, and I think it's a March time, the Chancellor or the head of the Treasury, so the head of the money, basically, in the UK government, will announce a budget, and that's basically like, this is what we're going to spend. This is what we're going to spend it on. This is where we're going to get our money from. Taxes, etc. And this is the system of it. So they're going to announce any changes basically that could affect people. Changing tax rates, that sort of stuff. In August, or no, sorry, I don't know when it is. It's around this time of the year. Sometimes the chancellor will announce like a mini budget. So different things that are happening, but they tend to be a lot softer. And because we just had an election, not an election, we just had a change in the leadership. They used the opportunity to lay out their new economic principles and foundations and ideas and how they'd implement that. And basically, what it led to was a lot of borrowing in the short term, which is problematic in this period because the past 10 years we've had very low interest rates, so borrowing is easy. If you borrow a lot, the financing of that is relatively straightforward. Now with inflation, if you borrow money, that feeds into the inflation problem, and it also leads, in order to tame inflation, the Bank of England then needs to keep raising interest rates, right? A lot of people's mortgages are tied to interest rates. So even though you want to have an expansionary global policy, we are technically in the midst of a downturn, or maybe just a bit before the actual trough or downturn of it, right? So it just, I guess, the markets didn't like it. They didn't like their plans. So what happened was that during the mini budget, the pound sunk, right? Investors were losing faith in the sterling. And the impact that had on my job is that we have a lot of funds that aren't sterling dominated, right? If the fund is in pound and we're investing in UK companies, there's no issue, right? Like the change is going to be the same for everything, right? The problem is that if we have a fund that's in pound, but it's investing a lot in US stocks. Actually, no, that's a bad example. It's the other way around. Sorry. If you have a fund that's in US dollars, and I got this right the way around. I should really know this. If my employers see this, I'll be immediately like, oh.
Dude, not everything needs to be memorized.
No, it's just basic logic. But so basically, if you have a cross-currency difference between the denomination of your fund, so if it's in one currency, but you're investing in stocks elsewhere, then you have that FX difference that feeds into it. So we were trying to see where there were potential UK sterling exposures for foreign denominated currencies, so a US or a dollar denominated fund.
So
Yeah, and we have to be pretty quick to that, right? Because that performance is immediately feeding into the fund's performance because the sterling has already dropped off. And we need to make sure that the fund managers are aware. And it's not just looking at the currency of the stock, right? You then have to look into the stocks. I know clothing companies specifically are ones that will struggle because if you think about a UK clothing brand, one that isn't so global, but mostly in the UK, they get their revenues in pound sterling, right? But the problem is their cost base is not in the UK, is not in pound. They don't manufacture the clothes here. They manufacture the clothes mostly in East Asia, and they pay those companies in dollars. That's their preferred currency. They don't want to be paid the local currency for various reasons. If they're volatile or whatever. So what happens is that your income is in pound, which is dying, and your cost base is in dollar, which is relatively speaking going up. So it goes both ways. So those are the companies that we'd have to quickly have a look out for because they're the ones that are going to be hit the most. And we have to do these exposure analyses very quickly to turn these around so that the fund managers have this information and they can act on that appropriately.
okay. And what is the response? So say you have a investment in US based companies with pound sterling and the pound is dropping. What's the move in that
Uh, so,
specific case?
so I mean, that's actually a positive move, right? If I'm a UK investor and I have my assets invested in the dollar, right? When I then go to withdraw those, it's unrealized, right? Because I'm not acting to withdraw it. But in that instant, like I'm doing great because I've got all my money in dollars, right? When I withdraw it back, I'm gonna have more pounds than I did before, irrelevant of what the market's doing. If I'm a dollar investor and I've got my money in sterling, then despite what my assets are doing, like I've just lost 10, 15% there, right? So it's the cross currency difference that we're looking for and trying to assess where that's most prevalent across our fund ranges. We have hundreds of funds and we have almost 1,000 portfolio. I shouldn't say the exact numbers, but we have lots of portfolios to manage, right? It's quite hard to be on top of every single one and be aware of what the base currency of our clients are versus what's in the fund versus the base of the fund versus the cost revenue basis of all the stocks within those, right? So yeah, the process is just quickly trying to identify where those cross-currency mismatches exist, drilling down as much as we as much as we can. We're restricted by what our systems will allow us to do. And then feeding that, summarizing that paper into, with your Excel sheet, but into a page or two, and then feeding that back promptly to the relevant fund managers for them to assess and act upon.
Okay. Wow. So last month was pretty crazy for you then.
A little bit. It's been much more active in the fixed income space, and there was like this LDI crisis that happened here in the UK as well recently.
What's
So it's to
LDI?
do. LDI is liability driven investment. So it's to do with the fact that it's a little complicated. I'm gonna try if I'm start using complex or terms needlessly, then just pull me up on it. But basically, what happened was that you have pension deficits in this country. Or that's not the best way of saying it, actually. You have mismatches in your assets and your liabilities for pensions, right? So if you're working for a company, you contribute money to your pension, right? And then when you retire, you expect to get this much money. When you break it down, it goes into cash flows, right? People are paying in, that's one cash flow, and people are paying out, that's another cash flow. So your liabilities are paying for people who are already retired, and your assets are the money that you're making from the people putting money into it. Now, one way to do that is you can just invest all these assets into stocks and high returning stuff, right? And then you just sell them down as you need to meet your liabilities. But it's not always efficient, because if you just happen to be in a downturn, then all those assets prices are depreciated and you're selling at at less than you wanted to, right? So what they can do is they can use something called liability driven investing. And what they try to do is they match what we call the duration of the liability with the duration of the assets. So they'll have their growth asset pot. So people, if I'm not retiring in like 40 years, right? Hopefully. So
Or hopefully,
um,
yes.
Hopefully, yes. I don't know. We'll see. Um, so they can put my money into growth assets, right? That's going to compound. It's going to take years and so forth, right? But as people get older, they care less about the growth. There's probably a lot of growth that's already happened, and they just want to make sure when the time comes to sell down those assets into a constant cash flow, their assets aren't at so much risk, right? So with liability-driven investing, you can use a lot of fancy security swaps and various things and options. And basically, what you try to do is whatever that cash flow, that next cash flow is, you want to make sure you minimize the amount of work and transactions you're doing, just to make sure you have the right amount of cash to meet that liability on the margin each and every day, and month and year, basically. It's not about just the final one. You need to build up to that so that as time comes on, you're matching your cash flows perfectly, right? But what it means is that you become very highly leveraged because interest rates have been so low. So you're not getting much return on these assets that you're now coming into. So it's beyond me. I did do it recently, my CFA, but it's beyond me right now. But they have to sort of leverage these already leveraged instruments in order to generate enough return to make sure they keep meeting the capital, the asset, the liability need, because this whole time your assets are growing, but your liability is also growing as time goes on. So you can't keep cutting down on this and the growth opportunities. You do need to be able to make sure this is growing as at the same pace as this, so that you're meeting it. If you start getting into a deficit, that causes other much bigger problems. But yeah, so we had this recent LDI crisis. So a lot of these LDI machine processes, interest rates were 0.5%. They're now much higher. I think 2.25. Right, that is a huge move. The pound sunk, which then increased the tail on longer term returns for bonds. So I think it's something like a 9 standard deviation move, in which case your hedge doesn't really work, right? It doesn't. You're not hedged for everything, especially since they were leveraging within the hedge itself.
What do you mean
So
your hedge doesn't work?
So I mean, that the hedge itself is fine technically, right? Because what happens is that if this moves this way, then this should move this way as well, right? But what happened was that they were technically, when you enter into an option, right, you have a margin account. So every day as the option price changes, you have to market your value. The reason you do that is because if your counterparty defaults or whatever, you've got the money at least in your option account. So you'll have the money as of yesterday, because rates were so low, they were actually using the money in the margin account, and they were trying to. This isn't totally accurate. This is the way I understand it. So don't hold me to it. But my understanding is that they were taking the collateral that they were posting, and then they were reinvesting that. So effectively, you're leveraging on your hedge, which is also already based on some leverage itself, in order to generate more and more return from these assets that aren't very return generating to begin with. So what happens is that there were quick margin calls because of the massive move. I've actually invested my collateral, and I don't get it back for a couple of days, but you can't tell them an IOU in 3 or 4 days. They don't, banks. You don't trust someone in that instance. You need that money, and you don't know the person on the other side. They'll probably have debts and collateral they actually need to post elsewhere as well. It's the cyclical nature of the sort of the securitized markets. But yeah, so that's my point really, is that it was a lot of leverage to meet it. The hedges were technically doing what they need to be doing, but obviously in such a big move, it's hard to prepare for that. And really, you don't want to be prepared for that, because if you're always going to be perfectly hedged, then you're not going to be returning getting much return on your assets, and then you're more at risk of your liabilities exceeding your assets, which, like I said, is a much bigger problem. It's a much more long-term problem to me. These are all short-term issues. This will get resolved. Thankfully, the Bank of England did intervene and start putting money back into the markets, because liquidity was drying up, and so valuations started to decline. But yeah, I've forgotten where we got into this point now. But
what happens if the LDI surpasses the assets? What is you said that was a long-term problem. What is the reason for that?
The liabilities exceed the assets?
Yes.
So the issue there, right, is that I owe, if I present value all my liabilities from now until all my employees I owe, those retired and those that will retire eventually, the present value of that is higher than the present value of my assets. That's
That
a
makes
problem
sense.
because I need to make sure that my assets are growing in order to meet that. If not, then my business actually will have to take some of the cash from off our balance sheet and move that into the pension accounts, right? And it looks like terrible management of your business, really. And on top of
Yes.
losing money from your balance sheet, investors lose faith in your ability to manage your company.
That sounds very similar to the bond situation in America. I'm not sure, but
Yeah, it's the
the
same underlying problem everywhere, right? Inflation goes up, so interest rates go up. When interest rates go up, bond values, fixed income instruments go down. They get devalued. The reason being is that their cash flow was linked to the previous interest rate, right? So if the base rate is 0.5%, then governments only have to give 0.5% interest. So any bonds that they currently have out there only have to give that 0.5%. Now the interest rate is 1.5%. So now all new bonds will be offering 1.5%. Well, then everyone in the old bonds is going to say, I don't want that anymore. I want the new one. So I'm going to sell out whatever the loss is. As long as the value is like less than the equivalent 1.5% bond, I'm making money. So you quickly have a fixed income crisis because people want more free money, basically. And that's what it is when you're buying US bonds. It's free money. There's no counterparty risk. There's no default risk, generally. This is not financial advice.
these are very complicated systems.
Yeah, I've been doing this for 4 years. I have a CFA, and I still struggle with it. Because unless you're in the depth of it day by day, like you're not going to be able to really follow this stuff very well. Like I've just shown in my terrible explanations of the past 20 minutes or so. Equities I know reasonably okay, but fixed income and LDI are a completely different beast.
I think you did well on the explanation. I think I understood it, a lot more because these news headlines have been coming out for the last month and a half. Brit, new British government is planning to have these tax cuts, and they're going to be terrible. Well, what's the reason that they're going to be terrible? And then
Yeah,
I think explaining that,
it's crazy, right? I mean, it's probably the last thing they were thinking about, the government, when they were doing this. They're not there to satisfy the market,
no,
right? But this is all economics. And your capitalist system's only going to work if you have a fully functioning banking system, and if they don't believe in your policies, then you will suffer for it, which sucks from a governance and what the government are trying to build. They're trying to build a better Britain with that is more growth orientated, but the timing isn't great, right? We have a cost of living crisis, inflation's soaring. You can't pump money into that system, you know.
So we have in California, we also have a cost of living crisis, even the entire USA. But especially in California, I think if you move into the interstates, at least you can get some much more affordable housing. What do you think could ease the cost of living crisis?
Well, the war has to end, right? That is the fundamental underlying reason for the cost of living crisis, right? It's an energy
The,
crisis first and foremost.
the
The Ukraine-Russia
Russian-Ukraine war.
war, yeah. Not the war in America, whichever war I could be referring to there.
Um,
I read an interesting article about The Economist saying that that Joe Biden's being too timid about weed, and they should legalize cocaine as well. But we can come to that.
we can talk about that afterwards.
Yeah, because that is fascinating. But yeah, I mean, war in Russia has meant that people don't want to buy oil, or people can't buy oil from Russia. That means that the limited supply of oil that we have in the world, prices shoot up. You have what is for some reason a legal cartel globally in OPEC, right? So they can set whatever prices they want. They can see everyone struggling with it. What are they going to do? Well, they're going to jack up the prices, right?
What do you mean by that? Legal cartel and OPEC?
So OPEC is I don't know what it stands for, but it's effectively a internationally legal cartel, right? Of the biggest oil providers in the world, and they meet and they set global oil prices. They don't target prices. They set it through supply, right? So if there's a global oil crisis, then they can just stop producing so much oil, which will jack up the prices and increase their profit margins, right? They can still, the speed at which they extract the oil is down to them. Obviously, they can't extract like an unlimited supply overnight, but they can certainly increase and decrease to quite a significant margin as they wish to. So what they could have done, obviously, is increase supply of oil production, because people aren't buying from Russia, and that would have helped with the global inflation problem. But what they're choosing to do instead is they're choosing to reduce supply and jack up prices. Energy is the main problem here because it's obviously to the individual petrol and gas and everything, and heating in the house maybe or whatever, energy, right? But then it's also an increase of cost to businesses quite significantly. They have to transport the manufacture of their goods from one country to another, and they have to do that throughout their entire supply chain. So it's not just their own manufacturing, but the manufacturing that they buy from, the companies that they buy from. So what happens is that the cost of all their production increases quite significantly over a very short period of time. So then they have to increase the supply of their goods, right? If you've got a company that produces a company that produces cars, right? A car is made up of hundreds, if not thousands, of different pieces of hardware and equipment. I know it came out a lot that Ukraine actually specializes in various parts of cars, and car manufacturing. I don't know what it is, like something to do with the radio or something. You just happen to have this plant in Ukraine where this is developed and there's a culture and society around it, and they're very good at that. So the world buys it from them. But I mean, irrelevant of that point. Point is that a car company will be buying goods from lots of different other manufacturing companies that will be manufacturing themselves around the world. If you want to buy a car, well, the cost of every little step in that has now increased, right? But yeah, so it obviously adds up and generates inflation. The cost of everything has increased. Companies have a lot of pricing power. The better companies will have pricing power. That's something that's valued by investors, and they can pass that cost on to investors. I mean, to retail people, to the individual. How else can you solve it? Through policy? God knows, right? I mean, it's a very interesting question on the policy side. They talk about cash v subsidy. If you I think the general consensus is to give people cash, and if they need it, they'll go spend it. But the problem is that then drives up costs everywhere else, right? Like even things that aren't directly affected by it, people start spending more money. A lot of it also is going to be the fallout of the COVID cash gifts that were given, right? People have more savings, more money. If things go up, they'll be like, well, I have the money. I'm not used to having this much money before, right? So I can just keep spending it. It's fine. It's no big deal. And all that leads to is just businesses pushing up prices more and more because they have that availability to. Last year, you also had the big rush in increase in pay, across the services sector. Everyone was jumping job to
Huge.
job. It was massive, right? And now all these service companies can't really afford to pay them anymore because their stock prices are going down. They're looking more at cutting, but they've got all these people they've just hired recently on huge pays. These people have now moved out of the cities. They're paying less on rent. They're paying less money on their mortgages, and they have more pricing or more spending power. So again, you have all these factors, energy, but also the recent influx of cash from COVID, which is sort of just pushing everything up, and it's madness. You could try start subsidizing things that we need, fuel and stuff, but unfortunately that encourages people to spend more. They were talking about, and they've been doing energy subsidies in Europe, and they've brought one into the UK now as well. But you have to do that so carefully because you don't want to encourage people to use more oil, really, or more energy in general. You want people to ration, but you also want to make sure that they can afford it. What is the best way to implement that policy? It's difficult, and it varies depending on what you're talking about. It's one thing on giving people petrol for cars, but it's another thing to heat houses. They're very different challenges, even though the underlying thing is the same. Thankfully, I'm not in policy. I'm an investment risk manager, and that's what I specialize in.
Yes.
But yeah, I don't envy the task that policymakers have right now.
No, it's a really complicated issue, and like you mentioned, there's not one factor, there's multiple factors. The situation in Ukraine, the COVID bailouts, just the lack of functionality during COVID, the markets last year, everyone switching jobs.
It's a bad time, isn't it, man? It's really not a good time.
No, it's not. Luckily, we're still young. We still have skills. We still have the ability to be employed and maintain any sort of costs that we need to take on over the next few months. But for people who don't have skills, for people who are older and are looking to get out of employment, um, the next 5 years seem like they're going to be a nightmare.
Absolutely. And I think, again, it goes back to what I said. People need to know how to manage their finances, right? They can't be reliant on their employer. They can't be reliant on the funds that they allocate to. They need to be well prepared for retirement. If you're in your mid 20s, mid to late 20s, and you're not already contributing towards your pension, you will suffer from that because the compounding difference is insane, unfortunately. And the fact is, I mentioned before, like I've been an adult for 8/6 years. I don't know that some people might not know that they're the compounding effect and what that means for your pension. And if they get to the mid-30s and then start contributing to their pension, they're already behind, and they might already have to work another 5-10 years just to catch up on that. It's like learning to run before you can walk, right? There's nowhere to
Absolutely.
go for all these answers, right? It's just everyone's on their own, unfortunately.
There's one place to go. Actually, Paul, you're little. His
My
dad,
big,
you're big. Sorry, you're
yeah,
big. A couple years before you were in the fraternity, he actually came to one of our meetings and had an entire like half hour, 1 hour long meeting about exactly what you just said. How, he's talking to a group of, men in their late teenage years, early 20s, a few of them older, but mostly young 20s, late teens. And he said that he said, if you guys start investing right now, your lives are going to be so much easier. He said the compounding interest is just going to be much more. You're going to, just by investing 5 years earlier, you're going to be able to make, I don't know, like twice as much money, some crazy number like that.
yeah. It's because it's exponential, right? That's how compounding works. Whereas, if you're just adding money to savings, it's just adding, rather than multiplying. So yeah, obviously the difference is quite substantive.
Very
Yeah.
substantive. And right now, the debt levels in America, just for consumer debt, like credit card debt, and right now, one of the big implementations within the last 2 or 3 years, maybe earlier than that, 5 years, is that you can put out your payments for 6 months. I don't know if it's a normal in the UK and in Europe,
Oh,
but
I was going to comment on this, but no, carry on. Yeah.
just in the US, you can pretty much any sort of payment that's over $100, you can break that up into 6 payments, 12 payments, even for cell phones, 24 payments over the span of months, one payment a month. And just people are racking up that consumer debt. And like I read an article that 1/3 of, and you mentioned this, we have to decouple our living requirements, our financial living requirements from a single employer. It's like one of the most, our single employer is super valuable. Like that's what's going to probably get us most of our income and most of the investments that we'll be able to compound with. But I think people, especially in America, they don't value saving so much. Maybe this is the same in Europe, and it they don't, like you said, put down into their pension, whatever that pension may be. It could be a home, it could be an actual retirement account. Instead they just spend it, or they maybe they do invest it, but then they also accumulate so much debt that whatever they're investing, it's nulled out by the debt.
Yeah.
And it's, I mean, it's ridiculous. Like, especially, I don't know if it's like this in the Europe and the UK, but a young man can accumulate, a young person, young man or woman, can accumulate hundreds of thousands of dollars of debt through education and credit cards alone. And it's it's nonsensical.
No, definitely. Yeah, I was going to comment on what you're referencing in terms of the breakdown in spending in present spending is it's something that we are seeing here. But I guess what you're talking about is both the asset and again the asset and the liability side, right? The liability is your spending here, right? America has an insane culture of credit card usage, right? That you do not see anywhere else in the world. Like, I have a lot of family in the States. I turned 16. Like, you don't have a credit card yet, Jordan? And I'm like, I can't even get a credit card unless I have a job here, like, because why are they going to hand out credit to people who have no income? Right? It makes no
Yes.
sense. And it's such a moneymaker. I think credit card fees range from like 20 to 40% for like the average credit card. At least that's what I've seen in the UK. It could be higher, it could be lower. But yeah, we definitely do not have a credit card culture elsewhere in the UK or Europe, as far as I'm aware. Whereas in the US, it is quite insane, and it's worrying for like society that like every person will, on average, will have so much debt that they build up that they can't afford to do. But by giving people this option and this culture, it's exactly the sort of behavior they're going to engage with. I think on the asset side, I think America's much better, and when I say asset side, I mean investing their money. Like, I think it's something like 30% of US stocks are owned directly by individual investors. They're not owned by institutional companies. They're not owned by Apple with its cash reserves and going into the market and buying stocks. A lot of it is owned directly by individuals, because you guys do have a culture of investing. You are aware of the investing options in front of you. In the UK and Europe, people don't really invest much money. A lot of them save, and even if they do invest, they're not very active with their investments. They sort of just leave it in a pot and they just don't look at it again. So whilst America has the benefits of the assets, they've got the difficulties and liabilities. Whereas in the UK and Europe, I think we struggle. We definitely don't have credit card debt, thankfully, as big as America on average, but we're not investing our money as much as we need to reap the rewards, really. But a lot of it is cultural. I don't know a single country in this world where they teach people about credit card usage or investing your assets, which is, the things that will affect your life more, the most in the world, right? This is money we're talking about. Which is just, yeah, it's insane. And the problem is that it's like banks and asset management companies that are being the ones trying to lead, good financial education to the public, but they're not the most trusted members of society, right? They've obviously got, unfortunately, quite a bad reputation. And that messaging really needs to come from entities in society that people do trust more. I don't know who anyone trusts anymore, right? Besides their friends and their family. People don't trust the governments. As soon as people, like other companies, start speaking about money, you just assume they want something out of you. So who is that institution that can come and help you and that you trust to tell you about how to manage money? Maybe it's charities, right? Maybe it's something like that. I don't know, but it's certainly a difficult problem in today's world, and unfortunately, something that's not going away either, right? I don't see any changes being made. I see companies trying, but just psychologically, yeah, I don't see any voice coming to save us.
No, I don't see it either. It doesn't seem, I mean, the people who are the loudest of the generation that is younger than us don't seem to be too worried about asset management. I mean, they do. They're talking about the biggest issue right now for people our age and younger is climate change. People are very worried about it, but the current financial situation within the world, it's interesting because 2008, I don't know how was 2000 the 2008 financial crisis in the UK.
I mean, it's the same everywhere, man. Any developed country, it was exactly the same. There was no hiding in that.
Okay. That, I heard about it. I honestly didn't feel it that much because, we weren't making any money. Our parents, if they did feel it, hid it from us as much as they could. Whereas now we have friends that are probably going to be directly affected by what's going on now within the next 5 years. And friends and acquaintances who have accumulated so much debt, and I mean, I don't know what to say, what's going to happen. People that are decades older than us that, you meet in the workspace and life, and you're just like, how, you don't, the job markets are changing, they're becoming less forgiving. How is this, how's the next 5 years are going to progress? The job markets are like, if you don't know how to use a computer very well, it's going to be very difficult to get a job. And so
Even if you do, right? I mean, like, I speak to people, more experienced people in industry, and all they do since COVID, all they've been telling me, Jordan, is that, you're in for a bad time. You're in for a very bad time. We're going to have, more or less on a societal basis, a repeat of 2008 happening. A lot of people forecasting recessions like next year, late next year, maybe early into 2024. But, people like to think, the recession's accepted, but it probably won't be so bad. It won't last so long. You'll get through it, and then you just figure stuff out. You either have a job or you don't. But really, no one can see this energy crisis and how long it's gone on for. No one can see when this recession is going to happen, and really how long it's going to impact us. You always have a restructuring after a recession. Banking was what was called 2000. You had a lot of regulation to sort of affect that. You're going to have an energy crisis and inflation-led recession this time around. We're going to have to restructure and get around that and become resilient to that. But people get lost on the way. People lose jobs. The new skills, as you said, that you need, just a lot of people in that generation will not have them. And rather than trying to rehire and retrain them, they'll just look to the future, right? That's how it happens. And then you just accumulate such a large proportion of your labor force that just aren't skilled and aren't prepared, and retraining programs just aren't there. And these people are just lost in society, right? They end up doing skills well below what their potential was. But society is bigger than these people. That's how we look at it's unfortunately how governments see this problem, and they just try to build better for the future while making the present not suck so much. We're always waiting for when things are going to be perfect, right? But it just it never really seems to be here.
No, it never seems to be here. I wanted to say something, and I forgot what I was going to say. What were you
Can we
what
pause
were
for a second? I just really I need
Yes.
to. Sorry, I'm a little sick and I've been drinking a lot of water. I just need to use.
And one thing that I think is different this year and is going to be interesting is the baby boomer generation. They make up a huge portion of the job market. I mean, in most of my jobs, actually, that I've had, there's a lot of baby boomers, not many Gen Xers, and then there's a lot of millennials. And so in the next 5-10 years, I think it'll be interesting to see how the markets handle the baby boomers retirements, who have they're pretty much the ones controlling businesses right now.
Yeah, I always get told by mostly baby boomers that like our generation just really aren't cut for leadership. We prioritize um, work-life balance and hobbies and interests too highly. And they think we're soft and not resilient type of people. Maybe it's true. I mean, I certainly disagree. I mean, when you think about a business, you only have a couple people or an executive team that lead it, right? So within a whole generation of people globally, you're going to have that 5-10% that are sharper and have those qualities to lead a business. Even if on average we are softer, like I think we'll carve out enough intellectual leaders and strong individuals to lead most businesses. I think that there is obviously going to be a larger population of people in the workforce who do value that work-life balance, and I think that there will be a tax-based issue, right? It's part of the general question about aging populations, right? If you have a smaller and smaller share of people working and paying taxes, and a larger share of people retired because people are living longer, then that is in itself a different problem. And also, these people who are working value flexibility, work-life balance, and maybe people are saying that those qualities lead to less well-run businesses. I think it's just about human development, right? Business needs to also reflect society and society's needs, and how we run businesses need to change to that. I think that you can make huge efficiency strides through this more flexible approach that people are pushing for. When people used to work 7 days and went down to 6 days, and then 6 days down to 5 days. I think when we went down from 6 days to 5 days, we didn't even have Excel.
Yes.
It's insane. And people are obviously pushing for 4-day work weeks with the same amount of spending power. If you're paying people the same, then the tax base doesn't decrease. It's just making sure that you are producing enough as a business to keep functioning for 4 days. I think that there's a strong argument that we make efficiency gains, and we can continue to do so as technology develops, to be able to produce that sort of workload. I think anyone who works in services or any similar sort of job, they'll know that they could probably do what they do in 5 days in 4 if they really push to. It's
Yeah.
similar sort of analogy to what I said about COVID. People under more pressure will produce more. I think that people could probably squeeze out in most jobs, and I think this is an accepted idea that in 5 days, in 4 days, you could mostly do, if you really wanted to, what you could do in 5 days. Obviously, there's less service to the consumer in a service-based sector. Then if it's Fridays we're not working, then you can't contact these people on Fridays. But really, what sort of urgent requests are you sending through on a Friday that you probably wouldn't even expect to have a response till Monday anyway? So
Yes.
yeah, I think that business can't control how society acts. I think business needs to grow and adjust and reflect as society evolves. And really, actually, when you think about it, the businesses that do that rather than try to fight and control society are the ones that end up the best. Because they promote that work life, they find a process that works for them and works for their clients. And it's the first one to find that sort of formula in that industry or sector will be the leaders, in that sense, and it attracts workers, it attracts skill, and then it improves the offering that you're able to make to clients. So it should work in theory. I don't see, and people are testing it. I know countries are trialing 4-day work weeks in various parts of their economy. Obviously, the sample size is always a bit too small, and every example is a bit too anecdotal to spread mainstream. But I think we're on the way there. And one of the ideas of moving from 6 days to 5 days is that people couldn't spend their money one day on a weekend. Even now, people want to travel more. 2 days, even if I go from the UK to Europe, flights will be like late morning, early afternoon. So that's my Saturday almost wiped out. I'll do something in the evening, and then Sunday, if I want to travel back, flights only like 4 p.m. right? And I have to be at the airport at 2. I have to travel. Like that's not even a weekend, right? So I have to take a day off. If I'm now taking a day off on a Thursday, then that Thursday and Sunday, you're spending more money. You're spending more time out there. People are happier. I think that if we as a society can't make that change now to 4 days, given all the progress we've made, then we're not really doing it because we can't. We're doing it because people think they lose money in the short term. Businesses think they lose money in the short term. So I know I sort of
Absolutely.
extrapolated a little bit from the original question you asked, but I think that the point still stands.
Yes, it does still stand. It's the exact same point. Is there's going to be less workers in the office if it's 4 days or 5 days. Same if baby boomers retire, there's going to be less workers in the office. And I think one interesting thing is one normal thing in here in places I've worked is the 980, working 9 days every 2 weeks, 80 hours a week. And like you said, those 3-day weekends, I mean, you can take a flight out Thursday night, take a flight back Sunday night. That's 3 nights, 3 days. It's just much easier. And even if you just want to relax, that's, and as you said, when people are more free, they spend more money. I had a job, and about my job, where I did a lot of international traveling. And during the times I was traveling, I wasn't spending any money. I actually saved a lot of money in those times because any money I was spending was on behalf of the project. So it was, hotels, vehicles, energy to move, planes. And so I wasn't spending money on myself, whatever that may be, entertainment, even at times food, just even transportation. Say I wanted to take an Uber to downtown. Well, I can't take an Uber anywhere because I'm working. So every transportation I'm doing is going to be through work. And so even having those 3 days, you're right. I'm putting more into the economy. I'm spending money. I'm spending much more money on that Friday, the Friday that I have off, than the Friday I'm working. And also going to what you said about us being softer, us being not willing to, enjoying work-life balance, but also you spoke to how businesses need to adjust. LinkedIn has changed the game so much. LinkedIn, and for us, Indeed.com, which is another job platform, because say I wanted to move to the United Kingdom and find a job in the UK. If I wanted to do that 20 years ago, before it would have been, I would have had to move to the UK realistically to do it. And then I would have had to, physically go to multiple sources, find out who's the best source, find a job. If I want to do that today, I go to LinkedIn, I find like UK work visa, Google that, do that, find out who's Googling, who is offering work visas for my uh, skill, which is engineering. They're going to be a list of companies. There's probably going to be some type of application that's real easy. And so you're right to say that businesses need to adjust, because the digital networking has put a lot more, and I think it became really obvious last year with that surge in income between people, when it was like, wait, I can just leave this job. Really, I don't know, recruiters were contacting a lot of people last year. I think it slowed down a lot this year, but last year and in 2020, it was just like, if you seem to have a good skill set on LinkedIn, you probably got contacted.
Yeah, they used to they used to contact me about stuff that wasn't even relevant to my job. Like
Yes.
they see risk and like, would you come like to do like credit risk for this hedge fund? And I'd be like, I could never do that in a million years. But they were just looking, man. They were looking for anyone and everyone. But yeah, no, I completely accept what you're saying, man.
Yes. And so moving on to something that you mentioned earlier, you said you read an Economist article that said uh, President Joe Biden, was too soft with only saying that marijuana laws should be adjusted and that even cocaine laws should be adjusted. What did you read and what do you think about it?
Well, I mean, it's the general argument that, and you can apply this across the drug sphere, right? I mean, the idea is that weed, and I guess this article was assuming cocaine, which, I mean, I'm not sure I completely agree with this, are sort of softer drugs when compared to opioids and heroin and everything else, right? But you could technically apply this to this concept to any drug, right? Is that rather than making everything illegal, you can create societal structures where you can go places you can go to where you can do this or try these drugs in a safe environment. And the benefits being, obviously, these markets are huge. People are addicted to drugs. A lot of people out there trying lots of different drugs, spending a lot of money on it. So you can institutionalize those, and then you create new businesses. You create, I guess, a type of entertainment sector for these sort of things. But most importantly, for governments, you bring in tax revenue. You also reduce tax spending on the enforcement agencies and on police and things, and maintaining prisons big enough for all these crimes. So you reduce your debt while increasing your revenue streams as well. You reduce crime more broadly in developing countries as well as your own. So there are a lot of obvious benefits. The obvious cost is you are potentially, or you're providing a forum for people to go try drugs that are very addictive and can be bad, if not deadly for you. So the trade-off is clear. With weed, I think that it's a bit simpler, right? Weed, people generally don't get addicted to weed. In itself, it is not an addictive substance. I think that there's an argument that people can build habits and routines, which in themselves sort of can be addictive or repetitive. So maybe we could call it psychological addictiveness to weed. But I think that we have a lot of people do weed, right? We know a lot about the drug, a lot more than we used to, and I think that I guess people can just be a bit more grown up about it. They know what it's about. Weed itself is not like an extremely, well, it's just not an extreme drug, right? Most people don't. It doesn't make people crazy. Doesn't make people do it like on the first instance of smoking weed. So it is, I'd say, sort of the softest of the illegal drugs that are sort of mainstream, right? So it's a very easy way to institutionalize if you wanted to have places just to do it. If you want to legalize it like tobacco or alcohol, and alcohol, as we all know, is much, much worse for you than 99% of drugs out there. I think it's just the general idea that we're a bit more in control of alcohol, which also is in itself something we can argue about. That is accepted. But the article was interesting because, they said weed is one thing, but coke is where we should go to next. And I thought, well, hang on a second, cocaine is crazy, right? Cocaine used to be illegal. There's a reason it's not, it's not legal anymore, There are so many like short-term and long-term problems with doing cocaine for you. It's obviously an extremely inherently addictive drug. I get it, right? It does make a lot of money. It does cause a lot of crime. Countries like Colombia are just at the mercy of the cartels there. And maybe there's more of a halfway house you can come to than just purely trying to legalize it. But I just thought it was insane. I mean, what do you think about that?
Well, I agree. Weed is an easy one. Marijuana is because people, you can't. It's very, very difficult to overdose. Nearly impossible to overdose on weed. So that one, it's a lot simpler. Once we get into the harder drugs, you bring up a lot of good points in the sense that, and this is one of my most obvious ones, there are criminal supply chains, even with the criminalization of cocaine, weed, all these other drugs, people still take the drugs. And, I think it was, I'm not sure what year prohibition of alcohol was legalized in America, but I mean, it utterly failed. Even if alcohol is a terrible substance, doesn't matter. It didn't matter if it was illegal. People drank. I mean, there were institutions that everyone knew about in the town. I mean, these are depicted, I forget, I think it's called Boardwalk Empire, but it's a really good depiction of organized crime in the post World War I, pre World War II America. And, these, I think they're speakeasies. Speakeasies popped up all over the place. Everyone knew about them. Even the cops knew about them. It wasn't so easy for them to break it down. And it's the same thing here with, other undercover cops, or same thing now. Cops know what's going on, who's doing what. They just can't hit it or handle it right away with great force, just like that, because of various reasons, which I'm not very sure of. But that's, they don't just, oh, I found this out, boom, hitting it. There's a lot of planning that goes in. But again, like you said, I think the biggest thing though is education. And that is huge because, one thing, like, prescription opiates are highly available. People can take prescription opiates, but a lot of people, it's pretty well relayed that these are highly addictive substances. You can get them pretty easily, but they're not so easy. I mean, it's gonna, you're gonna be addicted. Some people still do it. Some people are just either they can't control themselves or they don't care, so it's not simple. But I think the current state with the criminal supply chains, the dirty drugs, the, people still do them even if they're illegal. And,
Maybe we can cut to the, like, one of the, I guess, other areas of this though is the psychedelic side, right? Which
yes,
is strongly related to this. But when I was talking about places that are like, we can create institutions for people to have these experiences, that is definitely the spectrum of drugs that I was referring to. Having places for people to try out things like ecstasy, to try out ayahuasca, to try out these things is like, it's not just a cool idea, it's something that is actually happening. You look at was it terminal based depression, like people who have what we call like incurable depression, right? They're now trying psychedelic drugs to help through the therapeutic sessions, and they're having really good insights of this. Things like LSD, ayahuasca, MDMA, people are doing. They're doing it illegally. It funds. It's part of the revenue line of drug gangs. They're not going to do one, they're going to do all of them realistically, right? And if you don't want to legalize all of them, right, well, we can at least start with what I'd say are easier wins. These are drugs that, if made purely, if you know exactly what's in them, if they're made by regulated healthcare providers or whatever companies, you can really ensure the safety of people in those events, not just the one-off, but also in the longer-term future and their health, right? And you can provide a safe and enjoyable space for people to try out these experiences. So yeah, maybe we can't solve all these problems, but there are definitely angles that you can come into and start reducing revenue lines for organized gangs, while also helping and really developing society, right? These provide insights and opportunities for diversity of thought and experience that are unmatched in today's world. There are getting experiences mostly in these days means traveling, means starting new jobs, learning new skills. But drugs obviously offer a huge opportunity for having new experiences and learning things from those and being able to implement those ideas and concepts that you come across in these sessions and experiences to your own life, your job, your who you are as a person, your relationship to your friends, your families, all these sorts of things. So I think it's not just about reducing crime, but also you have to look at the opportunities that present themselves here and opportunities for human development and society development, right? I think it's actually exciting when you think about it in that manner and what
Yes.
it can happen. And I've been to a few talks about it where companies are set up, they're being FDA approved and approved by European drug lawmakers as well. And it's exciting to watch that field grow. And I'd love to see in 10, 15 years if they have these sort of safe spaces or institutions or whatever for people to try these things out and and really engage. But yeah, I mean, we obviously have mutual friends, people like Jacob, who are in these sort of spaces trying to make that happen. But yeah, no, I was just thought another angle to explore this sort of conversation, would bring some
Yes.
positive.
Yes. And even with those though, you got to be very careful. Like you say, they have to, because those are very contextual. It's better to be with people. It's better to have a safe space. But then say someone takes those very recreationally, and that can even end up terrible. So we've seen all these positive trials, and I think we both believe in the power of these drugs to help human beings and humanity. But people, there's going to be some repercussions, like you said, and there are repercussions with legalizing any drug. And
Yeah, but the same thing with what we have now, right? We trust people with alcohol, we trust people driving, like as long as we can get beyond the average, right? Like the top 95% of people to a level that is, like you said, people are educated and safe, then that is what we call a functioning society, right? You're always going to have, unfortunately, the 5% or so that will suffer for it. But maybe, if we took away every little thing, no one would have anything, right? In order to
yes,
progress for society, then maybe you have to let a few people suffer, but you just have to make sure that there are those support services available to them, so they're not lost, I guess, right? But yeah.
yes. So, Jordan, are there any last words that you'd like to leave our audience about what we spoke about today?
Speak to a financial advisor. Don't follow my financial advice. I had a question for you, Karush, actually.
What's the question?
Your name is spelled Kourrosh, right?
Yes.
But it's pronounced Karush. But surely, like the spelling would insinuate that it's pronounced Kurosh or something.
Yes, it is pronounced Courage.
It
And
is, isn't it? I knew it. Yeah.
yes.
Does it
The
frustrate you when people call you Karush then?
No, it's the American version. Courage is not a really friendly Kurosh. It's Kurosh. And
Kurosh,
that
yeah.
Rosh isn't really friendly in American vowels. It's a really
Yeah.
Middle Eastern. vowel like that. It
Yeah.
like, I mean, I could spell it. It'd be Koorh, Karash, but
Right. Yeah.
it's, Roosh is a lot easier, I feel like, for just with the American. Roosh is just so much easier with the American accent. I don't even know how it happened because
Yeah. It's not
it
spelt like that, so it's weird
it's
people
not
say it like
spelled
that.
like that. I have no idea. I took it on when I was like sit in first grade, 6 years old. I don't know if I told people that or if someone just called me Karush and then it just like stuck. But even now that I'm out of school, um, most people who meet me, they'll call me Kurosh, Koresh, even Koresh. Have you heard of Dave Koresh?
No, no, Uzi.
Dave Koresh was a what do you call it? He started a cult in Texas and he changed his last name to the same guy that I'm named after, which is the first king of Persia.
Right.
But he was like Koresh. His name was spelled Koresh. So some people call me Koresh or Karash, but it doesn't
No, I
frustrate
get
me.
it. Yeah, fair enough. Like I am, like a lot of when I went to secondary school, like I obviously don't have an Indian name, but I try and put like I pronounce my friends with Indian names the same as everyone else does, right? All the English speaking people. And
Yes,
like I remember there's so many examples, but one of the sixes was like I told my mom I was hanging out with this guy called Tushar. And she's like, Jordan, it's not pronounced Tushar, it's Tushar. Like Indian names and Asian names, there's more enunciation on the first vowel.
yes.
But I think in the English language, it's you tend to have more pronunciation as the word progresses.
What do you mean?
So we call him. I mean, it's the other way around. Sorry. So you're supposed to have like for his name's Tushar, Tushar, but we'd all call him Tushar. You just typically
Yes.
put more pronunciation on the first bit. Sorry, I got it the wrong way around. First bit and less on the end bit. Whereas, obviously, the way various other languages are formed, it's not synonymous at all. But
That's exactly the
yeah,
same case. Tushan, Karush, or Kurosh.
exactly. Yeah. Tushar. But yeah, I don't know. It's interesting. Anytime you see an Indian name, like you realize that they're all pronounced they're all pronounced wrong.
Yes,
But
I'm
yeah.
sure.
But
Naveen,
yeah,
is
cool.
that one pronounced right?
Naveen. Yeah, because double E, right? I guess
Yes.
if it's just one vowel in each. I think we can come up with another one.
Aditya?
Aditya. I don't know how you pronounce Adi's name. Aditya. I think you need something
Even
simpler.
that one.
But
Addy.
yeah.
We're
Adi.
not going
I
to call him
know.
Aditya.
I feel worse for Sri Lankans who have like very long first and last names, right? People just stick to the first
Oh,
4 or 5 letters and that's it.
what did you say? Shalagans?
Sri Lankans, like
Sri
Sendi's name, right?
Lankans. Yes.
Yeah, I mean
Holy
Sendi's
crap.
name
His last
is
name?
Senjura and Parajasingam, but people Sendi P, right? That's it. That's as far
Sandy
as you'll
P.
get.
Oh, yes. Oh, man. Your fiance is also Sri Lankan. Does
She
she have
is. No,
a,
it's not too long. Her last name is Balendra.
okay. We can
So
cut that too
yeah,
if you want
yeah,
to.
yeah, if that's all right. But yeah, it is funny. She always got some Sri Lankan family as well, and the name was just like so long.
Yes.
But yeah, no, sorry. I don't know why I wait this long to ask, but I thought I'd ask now anyway, so other viewers can learn.
Yes. Learn why I'm called Karush Koilu podcast instead of Kurosh.
Rush. Nice, cool. But yeah, no, man, I appreciate it. Thanks for having me on. It's been really fun. I'm happy to do it again sometime if you want as well.
Awesome. This was great. Thank you for coming on, Jordan.
Cool, no worries, at all, man. Thanks.